Life, money, action.
Welcome to Small Change, Big Gains, the podcast where we explore how small, intentional decisions can lead to major results in your financial life and personal growth. Whether you're looking to invest smarter, develop better habits, or simply find balance, we'll learn together how minor shifts can make a big impact. Join us as we unravel experiences, explore practical tips, and hear inspiring stories. Let's make it happen, one small change at a time towards big gains.
Welcome, everybody, to another episode of Small Change, Big Gains. Today, we have a special guest with us today, Maxim Sytchev with National Bank Financial Capital Markets or National Bank Capital Markets?
Capital Markets.
Capital Markets, got it. Welcome, Max. You are our analyst for the industrials, correct? And from what I hear from some of my colleagues around the banks is you're pretty in demand around Canada. You're literally considered probably the number one around Canada when it comes to some industrial analysis.
First of all, thank you so much for
Our
having
pleasure.
me.
So thanks for joining.
Absolutely. And listen, the reality is whenever the space becomes relatively hot,
Yeah.
automatically people become in demand. I mean, the same way as tech analysts were hot in 1999, oil and gas guys were in demand in 2013. So it's more just
Gotcha.
that type of function.
So before
Gotcha.
we dive in, when you say industrials, like some of our listeners might go, okay, well, what does that mean? Like, who does that include?
Yeah, is it cars, manufacturers, like
captured?
industrials, industries?
Yeah, for sure. So I cover a slew of different industrial companies. So everything basically transportation.
Right.
So it's engineering, construction, distribution. So the largest company would be WSP Group, which is the largest engineering consulting company in the world.
Right.
All the way down to...
They're the largest in the world.
Yes.
Okay.
Yeah, at 77,000
Wow.
headcount, which is pretty impressive for
Yeah.
a Canadian entity. Then I cover, distributors, so like Finning, Tormont, which, most people will see on, Canada's all kind of dug up and you're going to see like diggers.
Yep.
I see their buildings sometimes when I'm driving on the highways. I think they do equipment rentals, right, and stuff.
So rentals, but it's mostly sales of
Gotcha.
large scale equipment, product support, etc.
Yeah.
Then obviously construction, Aecon, Bird, North American Construction. And then we just actually launched on a couple of US names as well, AECOM and Tetra Tech. Also cover additional names on the consulting side. So, Stantec, which is a very large firm out west.
Yeah.
Very similar business model to WSP, obviously legacy SNC, so called Atkins Realis right now. RB Global, which is actually the leader in industrial auctions. They're the largest in the world. So it's interesting because on the one hand, I cover sort of a concoction of, like, the median market cap is 10 billion, which
Right.
like in the US context, like this is small cap. In Canadian context, it's actually sort of sizable.
Right.
And as I mentioned, WSP is kind of the largest at 37 billion. And then it drops all the way down to, I cover Auto Canada, for example, at, sub 1 billion valuation. So again, it's Canada. You have to be sort of jack of all trades in terms of industries. Ultimately, I basically cover like 7 different industries.
Right.
Even like Russell Metals, which is a distributor of metals.
Right.
Okay, cool.
Yeah, that's a lot.
Yeah.
That's a lot.
Yeah, but at the same time, I think there is actually a benefit to that because I find very often when you are siloed and if you just cover copper companies,
Right. That's a fair point.
you have one input and it's hard to differentiate, and sometimes different data points, they overlap or don't overlap in such a manner that it's hard to come to a different conclusion versus kind of consensus.
Right.
For me, I look at some of the consumer, manufacturing, obviously industrial,
Right.
infrastructure. So there is always something happening in my space, and I've been covering the names as an analyst since 2007. So I've seen many different cycles, iterations,
Absolutely.
etc. What kind of
You
makes sense.
you caught the crisis right in time then.
Yeah. So, like when, in 2008, you come into work and you don't know if your access card is going to work.
Yeah, I was there too. It was
You're like
intense.
praying on
Yeah.
the way. Please scan, please scan, please go green.
Yeah. So that was, a
That's
bit
too
of a
funny.
learning experience.
Absolutely.
You mentioned Canada and the US, and really quickly, just because I don't understand, I guess, the difference in the industrial space, what is the difference between yourself and, let's say, what your peers cover down south?
So typically,
Like the companies or whatever.
yeah. So generally speaking, U.S. companies are just much larger in scale
Okay.
because U.S. population is 10 times bigger than
Right.
Canada.
Yep.
So historically, like the G's of this world, like this is going to be like a 300 billion market company. Even like a good quality construction entity like Quanta Services, it's like a 60 billion US market cap entity. You know, Bird and Aecon, wonderful companies, but they're all sub 2 billion. What has happened as a differentiation dynamic in engineering space, actually Canadian guys are larger than the U.S. counterparts.
The engineering consulting?
Engineering consulting. So as I mentioned, like WSP is the largest by market cap in the space.
Right.
Gotcha.
And that's really was spearheaded by just a massive acquisition spree that the company has been on since they went public in 2006. And really, I would say laser focused strategy around just sticking with consulting.
Right.
Many other companies were sort of maneuvering between like, well, let's do full EPC, which basically means you do everything from A to Z, like where you do, feed, you do design, you do construction, maintenance, operations, etc. And it all kind of ended in tears for the industry. And then people started to kind of disaggregate the businesses and again, become a more consulting focused. And again, like WSP was one of the few firms that have kind of stuck to its knitting. And, like these things compound. I mean, the stock went public at $10 in 2006, and right now it's like, 280. So it's one of these enormous Canadian success stories, obviously supported by two Canadian pension funds, CDPQ and CPP. So that's what creates a differentiator. But otherwise, all things being equal, it's really hard to compete versus, the GEs, the Boeings of this world. I mean, it's just very different scale.
Right.
Right, yeah. Well, go ahead.
I was just going to say, if we zoom out for a moment and just think about what we're going through in today's world, again, we kind of laughed at the get-go here.
It's been an interesting year.
It's been an interesting year, and especially in your space as a Canadian, there's a lot of challenges in that space, but there's also a lot of trying to redesign, replan, rethink. What are you seeing and what are you hearing from companies that maybe we as investors aren't kind of listening to?
Great question. Yeah.
And I think, from a geopolitical perspective, these trends are, the train has left the station.
Yeah.
U.S. is trying to decouple from China.
Yep.
It doesn't make a huge amount of economic sense. I mean, like Ricardo would be spinning in his grave, kind of thinking about sort of comparative advantage and things like that.
Yeah.
But why doing this? And somebody kind of benefits from this.
Right.
Canada, by extension, has to, invest in defense right now, infrastructure. On top of that, like we had a huge influx of immigration.
Right.
So like it's a lot of the investments that we're making right now, it's a bit of a catch-up dynamic.
Right.
Nevertheless,
In Canada?
In Canada, the US. And
Okay.
actually, one of the ways that we try to capture and calculate these things, you can take a ratio of fixed capital asset formation as a percentage of GDP. At some point, I mean, like 25% is probably the right amount to invest in the economy. Like, I mean, China is doing it at 40%.
Can you quickly explain that ratio, like what the different variables are?
Yeah, so it's basically you take all the fixed asset investment, equipment, so like basically anything that goes into the ground.
Okay.
Plus, I think there's some sort of percentage of like maintenance, which is you have to do on existing structures.
Yeah.
And then you calculate it relative to GDP.
Right.
So, and what we have seen in Canada, we had dramatically underinvested in late 80s and early 90s.
Wow.
Oh, that early? I thought it was just. I don't know why I assumed it's in the last 10 years. Oh,
Yeah,
okay.
No, it's not a recent thing. And actually, over the last 10 years, we've been trending upwards. Because, you build something, useful life even for a bridge, like from an engineering perspective, it's like 100 years. It's not perpetuity. So you have to constantly replenish. So if you haven't invested 20 years ago or 30 years ago, like it catches up to you. So as I said, the I would say the sweet spot ratio is around 25%. The trough was 17% in Canada. Right now, we're like around 22%.
Okay.
And so, like, obviously, right now, the federal government is proposing to do these nation-building projects.
Yeah.
And
the budget comes out when I think
it's November 4th.
I think so.
Yeah.
I think
Soon-ish.
sometime next week.
Yeah. And we will see kind of the next batch of projects, coming out that, like, in all fairness, need to be done.
Are you feeling optimistic?
Absolutely, because, there is political will.
Yep.
And the other thing as well that I think sometimes people, they, going to complain about sort of leverage at a federal level, et cetera.
Yeah.
If you look globally, Canada, Australia, New Zealand, and the Nordics have the best federal balance sheets vis-a-vis GDP.
Really?
we're
Even with
actually-
all our very high taxes?
Well, I mean, that's a different discussion. Okay. But in terms of the actual leverage at the amount of debt at a federal level,
Oh, okay.
like it's not, like we're not talking about like sort of Italy, France.
Yeah.
Right.
Like, I mean, even China to some degree, depends how you calculate all these ratios.
Yeah.
So theoretically, there is the need to invest, both in terms of catch up, as a counterpoint to some of the geopolitical trends right now.
Right.
And also, we have the capacity to invest.
Okay, that's
So,
I don't know why I had, and I think
it's
maybe a
good
lot
to
of people
hear
say
that.
like,
I know,
I thought we
because
don't have the capacity.
Well, because it feels so negative, and that's why I
Maybe.
think when you talk to somebody like yourself who's in the trenches talking to these businesses and seeing it firsthand, you get a different picture sometimes, right? And you frame it in a different way than what you're kind of being told in the news all the time.
yeah, and I think again, like this is more of a sort of a global perspective,
Right.
Because I think when people kind of silo and they look at the trend line of, I'm just picking up a number of, debt to GDP at 55%, and right now it's going to 57. People have a very negative reaction.
Yes.
which is fine. But then if you look kind of globally, if that ratio is like 110. Well, you still have a lot of room. And
Right.
listen, like, I mean, obviously there is a GDP multiplier that has to come through. You have to invest in things that actually create economic value. So it's not, boondoggle projects or whatever, because I mean, like, let's be honest, like if you develop all the commodity stuff right now,
Right.
Yeah.
it's, first of all, like we do it in a responsible manner, in a geography where labor is respected, where environmental laws are respected, First Nations, et cetera. Like, I mean, all these things are taken into consideration,
Right.
versus some of the other, jurisdictions. So I think when you kind of combine all of these things, you look at, for example, what Norway has done, a very environmentally friendly society, very wealthy society, but at the same time, there's less pushback in terms of commodity development. So I think, as we are coming to more, I would say, realistic kind of approach in terms of how do you generate growth,
Yeah.
Right.
productivity, etc. I mean, ultimately, my coverage really benefits from that.
Right.
Yeah.
Right.
Now, Amy and I were asking ourselves yesterday. So you, of course, as an analyst, probably would go and chat with a lot of these companies that you probably cover. What's their sentiment, right? Like, what are they feeling?
Yeah.
Are they optimistic? Like, as a Canadian, obviously, when I hear the news and Trump threatening 10% tariffs here, and then one day sovereignty here, and one day this, like it kind of puts a negative pressure, on the morale, I'd say, probably of Canadian society. We're already seeing it a bit in the sense of like a lot of Canadians are refusing to go down to the U.S. In the interim. What are the companies? How are they feeling about the future of their investments?
Particularly, we were chatting about, if you look at some of the Canadian construction companies, a lot of them have projects and things in the U.S. Has that dynamic changed? And if so, how?
Or even like something like manufacturing, like like Linamar, I believe is what are they talking about? Like
So I don't cover Linamar, so I cannot comment kind of on their outlook specifically. But it's true that the manufacturing base is under pressure right now. So I cover Wajax, which is a Hitachi distributor. Plus, I mean, they have sort of like an engineering component to their business, and the manufacturing side is pretty moribund right now. Like absolutely. I mean, people feel it because that type of business correlates much closer to like a nominal GDP.
Right.
And I mean, right now it's kind of, bumping around basically, like, let's be honest, like zero, especially on a per capita basis. At the same time, listen, the beauty with businesses is that they have the capacity to adapt. So if I look across my coverage universe, there's only 3 or 4 companies that actually have 100% of their revenue coming from Canada. Somebody like a WSP, only 17% of their revenue comes from Canada. Everything else is international. Stantec derives 55% of its revenue from the U.S. Like it's.
But with the protectionist agenda, doesn't that put pressure on Stantec?
So the way that services are getting delivered, it's done sort of in situ. So it's done in the U.S. specifically, and it's going to be Stantec U.S. LLC, which delivers the service.
Right.
So it's really like a U.S. kind of standalone dynamic delivering services to local waste facility or semiconductor plant, whatever.
Yeah.
So I mean, that's where I think it's very important from an investment perspective to Amy, to your point, like the headlines is one thing.
Yeah.
And I mean, you always sort of hear this adage, economy and the market are not the same thing.
Yeah.
So for example, we talk about construction. Aecon's backlog has literally tripled over the last 12 months.
Wow.
$5 billion. If you look at organic growth rates for my engineering consulting guys, it is so like in terms of trends, it is the highest in history. So like in that 5, 6, 7, percent range. That's what we're seeing realistically from the companies.
Right.
So yes, obviously everybody has to be tactical and mindful in terms of some of the messaging, etc.
Right.
But business on the ground is robust, and everybody's just trying to figure out how to properly position themselves from competitive dynamic, etc. I mean, obviously there is things like AI, which can sort of complicate certain things. At the same time, I mean, the amount of capex which is going to the ground right now is unparalleled.
In Canada?
Well, in the U.S.
In the U.S., okay.
So in Canada, I mean, that's also why, the companies that I cover, especially the ones that have mostly of the revenue coming from the U.S., it's also much easier to be very optimistic about those companies' prospects.
Right.
Vis-a-vis like an SME in Canada.
Right.
Whereas, I mean, that would be a very different setup. Absolutely. So these are, like, let's be honest, like, public market, you have, I mean, first of all, to graduate to public market scale, I mean, that's already an achievement. And then being some of the largest companies in the world in your respective industry, I mean, you would typically gather, I would say, outsized gains to the top players.
Do you think? Do you see us like being successful in like the companies that you cover, or the industrial space, perhaps in general in Canada? Do you see them being successful in decoupling from the U.S. and maybe expanding more to Europe and more developing countries, maybe Southeast Asia or whatnot?
Yeah, listen, like, it's always a good question. When you kind of look at the map and you see like white spaces, I mean, the reality is certain geographies are just much more difficult to actually earn a return on kind of investment. So, like, yes, Europe theoretically at some point could be a productive place to be. I mean, some companies do have exposure to the UK, but only in very specific verticals. Like, I mean, water, for example. I mean, water utilities in the UK have been privatized.
Right.
I mean, I think you have to go back to Thatcher's kind of era. And they have been, because again, privately owned, they kind of underinvested, paid very large dividends to shareholders, but they need help from an engineering perspective. So right now, you look at the programs of investment in water in the UK, it's like literally up 50%, even though UK economy is kind of doing absolutely nothing. So you really have to figure out where to commit your capital.
Right.
It's hard to have this kind of blanket view, like, well, Europe is great,
That's what I thought.
or not so much.
Right.
Yeah.
So, and the other thing as well, like, I mean, like going into certain geographies is just the way of doing business, the accounting stuff.
Yeah, it's
it can be
different.
more complicated.
What about the Gulf? Like, I hear the Gulf is doing a lot of investments.
They are. And so again, like the large scale companies that I cover, like, the WSPs of this world, Atkins, RB Global, they do have presence in the Middle East.
Okay.
Right.
And again, you have to be choosy which geographies, the type of contracts that you want to take. Because again, like, you have to go back to 2007, where you had like an influx of like South Korean companies coming in and destroyed the margins for everybody.
Right.
Yeah.
Right now, like the Saudis were investing a lot of capital. Right now, a bit less. So that puts pressure a little bit on the investment cycle. At the same time, you look at places like Abu Dhabi, Dubai, very robust. But again, you have to pick and choose. You have to know your client. You have to make sure that they pay you, etc. So again, it's very hard to have like a blanket statement in terms of like go to the Middle East,
Right.
and like the red carpet is kind of out there. So that's where you can also differentiate which company has, I would say, the business models that are truly sustainable,
Right.
and can generate value for shareholders over the long term. Not just like, let's fill the boots with gigantic backlog, and then figure out how to deliver it.
Yeah. And
what you said earlier, the companies being adaptable, I think is important for investors to remember, right? We sometimes get tunneled like, this is all they do. And I'm like, well, they're able to make choices and decisions depending on the environment, right? And that's a really important piece. I want to go back. You mentioned AI. And obviously, that's a very hot topic this year, given the trend. And so in the industrial sector, when it comes to AI, but they also have the geopolitical, where's the balance? Are they having a lot of heavy AI conversations, or are they more distracted by the geopolitical? Like, where are they kind of down the middle?
Yeah, I think so. Geopolitics of AI, I mean, it's hard to gauge because, I mean, you see a different announcement, like, US obviously wants to do things. Then stuff is coming out of the UK. I mean, the bulk of investment is happening in the US.
Right.
I mean, part of that is regulation, just access to capital.
Yeah.
I mean, OpenAI private valuation is like $500 billion. I mean,
Right.
that's a private company. Like,
Right.
It's insane. And they're writing gigantic checks.
Yeah.
So the way that, we're thinking of it and positioning, I mean, ironically, Toromont, which is a Caterpillar distributor, they bought the small company in Hamilton called AVL. And what these guys do, they create a shell around a diesel backup generator for mostly AI data centers. And so you would think like, well, it's so niche and I mean, who cares?
Yeah.
But we're doing a facility tour with investors a couple of weeks ago, and right now that business represents roughly 4% of what Toromont does. I would be surprised if it's not less than 20% in 3 to 4 years.
Wow.
The growth curve is absolutely astronomical.
Wow.
Because the physical capacity, I mean, you see a lot of press releases, but we haven't started actually building. When somebody says we're going to build like 1 gigawatt, capacity data center.
Right.
I mean, you're talking about like, tens of billions of dollars.
Right.
And backup power is something that you have to have.
Right.
Even if you are powered, your primary source is nuclear to power the data center, you have to have backup power. And I think
I didn't know. Do they do that? I didn't know that they actually do that. But it makes sense that they have to have backup.
they absolutely have to. And those things
Sure.
have to run at least 24, maybe 48 hours if the primary source fails. And, these things get tested all the time. So, I mean, there's a bit of a product support
Right.
sort of attached to this. And, like all of a sudden, Toromont, which was kind of viewed as like a bit of a steady growth. I mean, like management team is extremely well respected, et cetera. But, the stock went from 110 when we upgraded it to 160 right now based on that dynamic. Because again, like the growth vector is so pronounced
Right.
and so visible, and there's so few ways to play it in Canada objectively.
Right.
That that's I don't want to say like it becomes crowded trades, but obviously the fund flow benefits the thematics. Like obviously in the US, the addressable market in terms of who to invest in is dramatically larger. But if you're trying to play it in a Canadian context, that's one way. Then on the other side, obviously AI. How do you deal on the consulting side of things? Because on the one hand, yes, people can be more productive.
Right.
How do you preserve pricing power vis-a-vis
Right.
your client?
Right.
So I think in the short to medium term, it's an absolute game changer in terms of cost savings, et cetera.
Right.
And we do believe there's going to be more of a decoupling of historically, if you wanted to grow your revenue in consulting, you had to have more headcount.
Right.
I think right now there's going to be you could probably do more.
Historically, if you wanted to grow your revenue, you needed more headcount.
Exactly.
To do
Yes,
more
it
projects.
was a linear
Oh,
correlation.
right.
Yeah,
Yeah, makes
yeah.
sense. Yeah.
So right now, I think that correlation will decouple somewhat.
Yeah.
We'll see to what extent.
Right.
But by definition, obviously, the margin dynamic will accrue to the biggest players.
Right.
Again.
Right. Yeah.
So the WSPs, the Statics of this world, the Atkins. So which is quite interesting.
Yeah.
Listen, I don't know what's going to be the end game around AI.
Yeah.
Because I mean, ultimately, it's from a society perspective, these are difficult
Oh, yeah,
questions.
it's a big difference.
Right?
Yeah,
I mean, like it's
yeah.
great to say like, well, all these companies are amassing kind of
Right.
capital, but what happens if you haven't
Yeah.
been hiring anybody for 5 years? But we'll see how that dynamic will evolve.
I don't need
over
AI
time.
to write an email. I just need AI to cook and clean and do my laundry for me. That's what I need.
I would
I don't need it
love
to.
that
I'll
as
write my
well.
own email.
Yeah,
Well,
I'm with you.
Such a good point.
I'm with you.
Love it.
Well, I think my last question
Yeah.
was to ask you about, again, because we started off with like the economy and all the challenges, and I was going to ask you about the green shoots, but I think you've covered that. I think there are a lot of green shoots, particularly in your sector.
Yeah, it sounds like there's great opportunity.
There's a lot going on from a more positive standpoint, and that's fantastic to hear.
Yeah, absolutely. Listen, I think again, as you mentioned before, businesses are adaptable. I mean,
Absolutely.
that management teams are paid to find the way through the cracks.
Yeah.
Of,
Yeah.
policy. You have to, sometimes you have to be, lean into, M&A to find expertise. Sometimes you have to obviously adjust headcount depending on where things are. But ultimately, I think that's sort of the beauty of the capitalist system is that companies have that innate capacity.
It will create more winners and losers though. Like it's still going to be a bit tricky because you mentioned management. I think I would probably make the claim that a lot of the management are used to, I guess, quote unquote, free trade agreements and just like more rosy than thorns. So maybe this thorn road is a bit a new road for them, but definitely, as you said, they are getting paid to make it work and definitely being adaptable.
Yeah, for sure. Listen, at the same time, I mean, like some verticals are obviously under pressure right now. I mean, like ag. I mean, I cover ag growth. I mean, there's more pressure in farm.
Yes.
Yeah.
Yes.
Like I mean, ATS was doing extremely well at some point on the back of EV.
Right.
Sort of ramp up. I mean, that came down. But healthcare overall is doing well. So again, like it's like I don't want to be sort of painting kind of this like rosy picture that everything is amazing. I would say on average, companies are doing, I would say, much better than anybody would have thought.
Yes.
You see this in their growth ambitions. I mean, there was an article in Bloomberg around WSP potentially thinking about Jacobs. I mean, that would be an absolutely transformational.
Jacobs is
Jacobs Engineering in the U.S.
Yeah.
I mean, you're talking about a combination of like a 36 billion and a 26 billion.
Oh wow, that's
massive.
massive. Okay.
So I mean, the fact that there's percolations of that level of activity. Static is looking at M&A, like it's all positive for. I think ultimately for Canadian industry.
Okay, that's good.
In general, because it also means that. People complain about like, it's hard to create kind of mega cap, tech companies. But I think on the industrial scale, there are certain niches where companies are truly leaders. If you look again, as I mentioned, WSP, like Finning is technically the largest Caterpillar distributor in the world. RB Global is the largest auctioneer globally. So it's interesting how certain companies have been able to find their niche, kind of persist over decades, literally. So I think that's very exciting.
I think you put a bit of optimism in me.
I know.
Why not?
I know.
Honestly,
Why
you
not?
did.
Max, we can't thank you enough. Thank you for
Max.
joining
Thank you
us. That
very
was a
much.
great
Absolutely.
discussion and a great overview.
I loved it. Thank you so much.
Thank
Have
you,
you back
Max.
next time.